Good afternoon, everyone. My name is Mark Landers, and here to welcome you to our tax planning and best practices webinar for small business. My apologies that we're a couple minutes behind schedule, but anyways, we're eager to chat with you and exchange some great ideas and information about how to be a bit stronger with your planning and being effective for tax purposes. I am the managing partner of a firm called Hahn Landers. We're based here in Mississauga and working mainly with private company owners. I'll pass it over to our guest speaker, John Sears. John is a chartered accountant for many years, runs the firm Sears Chartered Accountant, and a good friend of mine, and also someone who's got a deep knowledge of private company ideas and taxation. So I'll pass it over to John, and John, I'll put you live in a sec here so you can say hi and introduce yourself.
Okay, hello everybody. Just wanted to thank Mark for the opportunity to do this presentation today. Little bit about me. I'm a small boutique firm in Oakville. About 18 years of experience as an accountant. There's 7 staff. There's 2 partners here, and we work on small, medium clients, much like yourselves, private companies. We have a specialty in taxation. I completed CPA in-depth a few years back, and that allows me to do mergers and acquisitions, estate planning, corporate restructuring, and other fun tax stuff. So enough about me. If anybody has any questions as we go along, hopefully I'll be able to see them in my corner, and I'll try my best to answer. I may wait till the end, or I may just jump in, just depending on the question and sort of how we're doing for time. So a question I get very often from everybody is salary versus dividend. And this is a discussion that happens constantly, at least once a week. And like many questions in the tax world, the answer is it depends. There's pros and cons, like most things in life. So if you're going to pay a salary, one of the great advantages of a salary is you're able to get RSP contribution room. Sometimes that's good, sometimes it's not. It depends the funds. If you want to use the funds for your business to expand your business, you want to invest in real estate, life insurance, things of that nature, it might not make sense to move the money into an RSP. It might make more sense to leave money behind in the company and just take dividends. So that depends. But if you want that RSP room, it's very important that you take a salary. Dividends do not generate that. Another nice advantage to the salary is you're able to deduct it from income, so you're able to get a reduction for your corporate taxable income. And very often we use bonuses where the taxes doesn't have to be paid for 6 months, and we're able to put it into the next fiscal year. And depending on the circumstances, it's a nice opportunity to have that. It's not subject to TOSI, tax on split income. I'm not going to go crazy on the tax on split income, but these were the rules that were put in by our friend Marneau, who's long gone now, back in 2017. Particularly, he was trying to eliminate the ability for children who are over 18 and spouses and other individuals in the family from getting dividends and splitting income. So it worked really well for a long time, especially with professionals. Another nice thing with salary, and I've seen it a few times now, is you can elect to contribute to employment insurance. Generally, you elect not to, but sometimes if there's a maternity leave coming for your spouse and she's involved in the business, it may make sense to take to spend the money on that EI and be able to get it. That's a discussion to have with your practitioner before you do that, but I have done that a couple times successfully. A few cons related to salary. You have to remit payroll taxes, as I'm sure many of you know. The penalties are not fun if you miss it. You got to do it every month by the 15th. So that's not fun. Also might be subject to employer health tax. Employer health tax, it's gone up. The exemption used to be $450. Now we're at $1 million. So it's less and less people these days that are being affected by employer health tax. But it's something else that has to be considered, because even though you own the business, you may have to pay the EHT, which makes dividends more advantageous. CPP is one of those things that it depends how you look at it. I think CPP is a bad deal for business owners. You have to pay the employer and the employee side. And if you die, unexpectedly, you'll get your state will get the $2,500 death benefit, and that's it. You lost all that money you've been contributing to CPP for many years. Obviously you can't choose how it's invested. And if, the government decides they want to raise the age or, God forbid it goes broke, it might not be there. So I'm a big advocate of holding on to my own cash. So I don't like CPP. And again, the biggest disadvantage is you have to do employer and employee side. So you're getting hit twice. Whereas an employee only has to pay their side. So it's not a bad deal for an employee, but it's a bad deal for a business owner. Another con to the salary is it has to be a reasonable expense. I've only seen an issue once. I took over a physician many years ago, and they were deducting a $200,000 salary to their wife, who unfortunately really wasn't doing much for the business, and it was denied. That's the only time I've seen it. But I do try to not let the salary get unreasonable. I'm sure many of you pay your spouses, your husbands or your wives to work in the business. It's important you talk to your accountant about whether the salary is reasonable, and having some paperwork to support what they do isn't a bad idea. Timesheets, employment agreements, because it does get audited from time to time. I don't take it as a rule of thumb, but anything over 50,000, I've never seen a problem. Anything under 50,000, anything under 50,000, I've never seen a problem. Over 50,000, we need to make sure that there is some duties that are being performed for sure by the spouse, and you may want to get some paperwork to support it.
Hey, John, just on that specific note, was it a few years ago there were some changes and they sort of made the documentation of this a little bit tighter than maybe it was previously? Or?
Yeah, thanks for the question. For dividends, absolutely. So this TOSI, this TOSI, which has been thrown around a lot, is I think what you're talking about. They've made it very difficult for spouses and children to get paid dividends. I deal with a lot of physicians, and specifically physicians, they were going after on this one, and other professionals. Because sometimes they were splitting dividends 5 or 6 different ways and not paying any personal tax at all. So in 2017, these new TOSI rules were proposed, and they came in January 1st, 2018. And there are a few ways out of it, Mark. You can, if your spouse has been involved in the business in the past, if the business owner is over 65. So they came out with all these carve-outs because there was a lot of crying out there about it not being fair. And there are some situations where we can still pay dividends to non-involved family members, but it's trickier. It's definitely more narrow when you can pay it. As far as salary changes, no, the salary has always just had to be reasonable for the work performed. Mark, does that answer your question?
Yeah, that's great. Thanks, John.
Yeah, no problem. No problem. Where are we? Dividends. So pros, we don't need to register a payroll account. So that means we don't have to worry about payroll penalties for missing our remittance every month, which is nice. You're not going to be paying CPP on those dividends, which is also nice. Again, that's more of a personal preference thing with me with CPP for the reasons I said before. There are clients of mine that have businesses and they really very much so want to partake in CPP. So, there is another side to that, but I gave everybody my personal opinion. Another nice advantage to dividends is some of you may have refundable taxes. If you don't know what that is, that's okay. Sometimes there's monies in the company that can be paid out and you get a refund in the company. Usually what generates that is if you have portfolio investments, like with Mark, for example, and you receive some dividends during the year in the company, that's going to generate refundable taxes. So, that's another nice reason potentially to pay dividends over salary because the company's going to get a refund. So it's a good thing to do to talk to your accountant to see what your refundable tax balance is before you decide salary or dividend, because you might just get a check back for paying that dividend. The last thing I wrote here for pros was the ability to pay eligible dividends to save tax. So again, if Mark's earning you lots of nice dividends, and I bet you some of them are Canadian dividends, they're going to be eligible. and you actually get a really nice tax rate on those eligible dividends, and you'll actually pay less tax than you would earning a salary. So, it's good to talk to your accountant about refundable taxes, good to talk to your accountant about eligible dividends, whether that's available or not, and that'll be in the corporate tax return. So a few cons of the dividends, and I alluded to some of these earlier. They don't generate RSP room. You don't contribute to CPP or EI, and they're subject to the tax on split income rules, which again TOSI is a very complicated topic, and it's very important when you're looking at any dividends to see if TOSI applies. And I'll just say, kind of from a high level, we haven't seen any TOSI audits yet. We keep waiting for them to see how hard they're going to crack down on tax on split income. But I think after COVID, we're probably going to see some and get a better idea of how hard they're going to come down on these dividends. So Mark wanted to do a little section on effectively using debt. So I just had a few topics here just to discuss really quick, just some general ideas.
One thing I'll say, John, and I grew up in a household that was not an entrepreneurial household. We learned a lot about money, but debt was always kind of a really bad word. Growing up and then getting into business and seeing experience with clients and even my own business, I've seen that debt can be kind of effective if you use it right. So I'd love to hear your perspective on this,
Yeah, sure. I'm a big believer in Rich Dad, Poor Dad. I don't know if any of you guys have watched some of his stuff, but he has good debt and bad debt. So, keeping it really simple for everybody, there's bad debt, things like credit card debt and other things that have really high interest rates that aren't deductible or may not be deductible. And then you have good debt. You have things that generate you more, income than it costs you to borrow the money. And so I'm absolutely a big believer in debt. I wouldn't have been able to buy my business originally without debt. I was able to leverage it and earn more income than I paid in interest. So if you're able to do that, absolutely, debt can be a good thing. It's good to do a cash flow analysis very often, I find, to see, how are you going to do in a year, 2 years, 5 years, and also factoring in potential changes in the interest rates. As we all know, interest rates are almost for sure going to go up next year, given the inflation rate being as high as it is. So I'll just give you guys some thoughts I had on this. So I always, when I talk to clients, you have to be very careful when you're using debt for business purposes to make sure that the interest is deductible. I've been in a few situations where the money isn't easily traceable back to a line of credit, and we run into interest deductibility issues when we get audited with CRA. One of the nice things I've done with some of my clients is we actually split lines of credit up, because very often people are using home line of credit these days because, there's just so much equity people have in their homes. And we split the line of credit up into two numbers. We'll have like a -01 and a -02. And anything in the 02 is business and anything in the 01 is personal. And it's very clear when there's an audit, if there's an audit, that CRA can see that everything that came out of that account was business. Because I can't tell you how many times, Mark, I've seen where people are using lines of credit and they're funding both personal and business use. And we have to figure out the interest portion that's deductible. And it's a bit of a dog's breakfast when we get to actually trying to figure out how much to deduct on the tax return. As well as getting it past CRA. And as soon as they see personal expenses, it becomes a much more difficult process. So that's just one idea that you can do, which is split up your line of credit with your bank, and it's not hard to do that. So if you had, say, $1 million in line of credit, you could split it up into 500 and 500 and just separate it that way. One other thought on the credit cards is a lot of my small business owners use personal credit cards. Also a nightmare for businesses when we get audited. If possible, try to get a corporate credit card. There's a lot of programs these days where the personal and the corporate credit cards will give you air miles in the same account. Because I know that's a reason a lot of the time people want to use one credit card. But again, in audits, to make sure we get the interest deductible for the credit cards, super important, that we have a separate credit card, preferably in the business's name. And, I've seen that been a problem in the past with audit. Individual debt versus corporate debt to fund the business. Both are possible. I prefer corporate debt where possible to fund a business, but very often, I think I'm talking to a lot of small business owners. The bank just won't give you enough money, or they won't give you the money in the company because they're not comfortable lending. So a lot of the time, we're using individual debt. Of course, the issue with the individual debt is if the business goes bankrupt, we're on the hook personally. Whereas the corporate debt, if you're able to get to a position where the company, you're not making personal guarantees and it's only the assets in the company that are at risk. But again, small businesses, more difficult. As you get bigger, it gets easier to do this. The bank may require a review or an audit from the accountant in order to get more and more corporate debt. Corporate debt also tends to be at a higher interest rate as well. But again, maybe less risky from the stance that if the business goes bankrupt or you have financial difficulties. Whereas the individual debt, you typically are able to get it at a lower rate. And in turn, you can lend it into the business and you can write that interest off on your personal return. And the company will then owe you that money back. It's important you get it all papered properly with a promissory note so we can support the debt later. But you will be able to get an individual interest deduction if the money goes into a company. So there's pros and cons, as you can see, from individual versus corporate, depending on the situation, but both are possible. I thought I'd talk a little bit about the Smith maneuver as well. I'm sure many of you have heard about the Smith maneuver at some point.
Hey, John, just one question before we get to the Smith maneuver. I heard from a client a number of years ago in a situation where there was some lending. I think it might have been between related companies, and because they had legally set the debt as some kind of a secured debt, I think it was some kind of a legal arrangement that they kind of got protected when they got into some financial difficulty. Is that something that maybe you could speak on? I know it's more of a legal thing.
No, absolutely. I talk about this all the time. Yeah, thanks. That's a great question, Mark. It's one of the nice things about having a holding company or, a more elaborate trust setup where you're able to take out the retained earnings out of your opco and you're able to move it to a holding company and you're able to loan that money back. And what you do is you do it on a secured basis. So it's something special your lawyer has to do. It's called a general security agreement that needs to be done, and they register a PPSA. And what that does is if something goes wrong with the company, there's a bankruptcy, for example, you're now registered, as a debt holder. So very similar to a lien. Lawyers don't call it a lien on a corporation, but that's basically what it is. So now, typically it'd be the bank would get paid first and then you would get paid second. This would be your holding company that would owe the money. It'd be owed to your holding company, excuse me. And then all the other creditors, so the vendors, if you owe trade payables, things of that nature, they would all have to split up what's left. So this gets missed quite a bit, especially for small businesses. They get big retained earnings buildups over time, and they've got nowhere to put the money. They've got nowhere to dividend it out, and they don't want to pay the tax on it. This can be a great opportunity to create a holding company or a more elaborate trust structure, which I'll touch on later. But it gives you the opportunity to get that money out and lend it back and protect it. Mark, any follow-ups on that, or?
Oh, that's all. I didn't know all the intimate details, but that was exactly what I was talking about. That's great context there.
Okay, thanks. Appreciate that. So Smith maneuver, it's been around a while. It's been around for so long, it feels like we've stopped talking about it. And once in a while, I bring it up to my clients. They have significant money in the company, and they have significant debt outside. They have mortgages. It can even be simpler. You can do it without a company. But with the company, you can pay the money out that you have in the company. You can pay your mortgage off. And you go talk to your banker and you set up a home equity line of credit or a new mortgage, and you put that money back into the company. And then that money you use in the company, you invest in your business or you do other ventures of the nature of trade, let's say. You can write off that interest now. So abracadabra, your mortgage interest is now deductible. There's more to think about regarding this. There's penalties if you pay off your mortgage early. There's a bit more thinking that needs to go into it. But at the time of your renewal, you're sitting on some cash in the company, it's not a bad idea to do this. And then that mortgage interest that you're paying personally, we may be able to deduct it for tax purposes, which works quite well. I've done this a few times now. It's gone to court and the taxpayer won, so it's okay as long as it's all documented correctly. And it's good to talk to your practitioner about that, about thinking about doing that. And you can also do it without a company as well. If you have personal monies, you can pay off your house debt, remortgage your home, and then if that money goes directly, let's say to Mark, and he does some great investing for you, now you've got some interest expense that you can deduct against your returns. And it's not leveraging, because you already were leveraged. We're just making the interest deductible, so you're not really putting yourself in any more risk. So it's something to talk to your accountant about to see if it makes sense. But I've done this a few times with a few clients, and it's worked out pretty well.
Great insight there. Just a quick reminder, everyone, if you do have any questions, there is the live event, the Q&A on the right-hand side of your screen. So feel free to enter anything if you'd like some more context.
Yeah, and I don't see any questions yet, but yeah, go ahead. I'm not shy. I can walk and chew gum most days. So go ahead. Had my coffee. Go ahead, send me a question, and I'll do my best. And no dumb questions, guys. Feel free to shoot me anything, and I'll address it to the group. Okay, so employees versus contractors. This is a big topic again. It comes up all the time in my practice. Everybody, all of us business owners want to just have contractors. We don't want to have employees anymore. Why don't we want to have employees? We don't want to have employees because the way the employment law is for the most part. And they're happy to not be employees. They're happy to be businesses so they can deduct expenses. And you hear about people doing this all the time, and me being a tax accountant, I get the other side of it where it doesn't work, where the individual, he's dictated by his employer, the hours he has to work, the tools he uses. There's no risk reward of the business. He has no other clients or people that he works for. And then, when CRA comes along, and they reassess and they say, this is not a contractor, this is an employee. It's even worse if it's in a company where the person who would otherwise be an employee is the contractor who should be an employee is incorporated. They end up paying a top tax rate and they have no deductions. It's awful. I've been through it twice. Clients I've taken over where they had that structure. And I warned them, but they decided to roll the dice. So that's the employee side. The employer side, they end up owing all the payroll taxes plus penalties plus interest. And if you get audited once on this, you're going to get audited again on it. That particular second client I'm thinking of was audited, 3 years after that, and they just didn't leave them alone. They wanted to look at all their contractor payments to see if there were any other employees. So it's important that before you go into it, maybe I'll say one more thing, actually, from a legal perspective before I conclude on that. It's important before you go into that you also understand you may not be escaping severance as well, because if it walks like a duck and quacks like a duck, a good lawyer is going to win. And even though that contractor, you thought you just stopped using their services, they're going to get severance. And I've also seen that in my practice a couple times now. So I put some pros and cons up there just to sort of think about, in general, employees versus subcontractors. Employees, when they're employed, they're tend to be more loyal. They're working for you only typically. They don't have other clients or customers. They're there when you need them. You can set their conditions of employment, whereas a contractor, you shouldn't. So, if you need them to be in your office working every day, or you need them to work certain hours, you can figure all that out in the employment agreement in the beginning. And basically, you have more control over them. A few cons with employees, as we've discussed, you have to pay severance. And something I get I'd say at least every couple months is, I'm letting someone go. And again, guys, I'm not a lawyer, but I only have to pay them 1 week per year. That is so far from the truth. There's a few severance calculators online. They're all pretty good. I think severanceCalculator.com might be payseveranceCalculator.com. It'll actually just ask you a few simple questions, and you'll be surprised at how much severance people are entitled to when you let them go. And that includes laying off as well. They can treat that as a dismissal. And basically, you as the employer, you're going to lose most of the time. So I've had a few clients go through it, and very often they, especially a more senior person, I've seen them pay a month's pay per year, sometimes more if there's damages as well. So I just referred I guess I shouldn't plug anybody, but an employment lawyer to a friend of mine, and he was about to let somebody go. He thought that it was just 1 week per year, and it was somebody who had been with him for 20 years, and he was expecting 20 weeks, and we did the severance calculator, and it ended up being 14 months. So it's very important that at minimum you do your own independent research. And what I would suggest is talking to a good employment lawyer before you do anything to avoid massive severance. So other cons to employees, you've got to pay their payroll taxes, their CPP, there's EI, there's WSIB, there's EHT, benefits. So there's a lot of money that's going out the door for employees. They're very expensive. And then there's always what happens if there's no workaround, which has happened to a few of my clients during COVID. And luckily we had some government benefits, which we'll get into in a minute. But you still had to pay them even though they weren't working. So that's definitely a con of an employee.
I'm going to say, John, you're kind of making this running a business sound kind of complicated. This is getting a little tricky,
Well, it's important. I always say know what you don't know. And a good way to know what you don't know is to talk to guys like you, Mark, talk to guys like me, talk to your lawyer, talk to colleagues, and because you're going to be making lots of decisions over the course of a business, and it's very important that you really think about things before you do them. Like me personally, I've been angry in the past, once or twice, and I always have to check myself not to make a decision while I'm upset. I think it's very important to take, this is just some general business advice, I suppose. Don't ever make a decision, or especially a big decision, while you're upset or angry. Always give it 2 or 3 days. Talk to the proper people and give it some time to think. Because I only say this because I have many small clients who shoot from the hip sometimes and make poor decisions and regret them later on.
Sounds like you could maybe moonlight as a life coach. You got a lot of wisdom there, John. I like it.
Yeah, I'm a little bit of a psychiatrist sometimes too with clients. I hear things I don't necessarily want to know sometimes, but I'm happy to have those close relationships with my clients so I can advise them well.
That's great, man. That's great.
For sure. So the trend is, as I mentioned at the beginning of this, is everybody wants to be a subcontractor these days. Talking from a high level, it can be dangerous. So just be careful. Talk to your lawyer, talk to your accountant, think about it before you make a big decision like that to switch employees over. Because a lot of the time, if you think they might be an employee, they probably are an employee. Been through a lot of audits recently on this. You'll always hear from the people who don't get caught, how they're getting away with it. But I see the people who do get caught, and I'll tell you now, they wish they had, treated them as employees from day one. I've talked about the payroll taxes, and I've talked about the severance already. So I thought we'd talk a little bit about COVID-19. I know we're all pretty sick of it. I know I am, but there are some programs that are around. There's some that are wrapping up. There are some that are done. I'll talk a little bit about the more popular programs, the less popular ones. I think I provided a link. You can research them yourself. And with that, I'll kind of continue here. So all the COVID programs in general are winding down. The biggest one as business owners probably took advantage of, or the biggest ones are the first two, are the Qs and the CEBA. I'll see if I can remember all my acronyms. That's the Canadian Emergency Wage Subsidy. Some people called it CEWS. Qs seem to be the more common pronunciation. The last one was September 26th till October 23rd. That was Qs period 21. So we actually had 21 periods of Qs. It was a great run. A lot of businesses benefited very well. There were a few different ways to qualify. If any of you haven't looked into it, I would still suggest you either look into it yourself and involve your accountant, and they can help you apply for it. The calculator got easier as we went along, but it's still not something that can be figured out relatively quickly. But if you have any interest in claiming it, now's the time to get going on it, because as you see, the last period is April 1st, 2022 to apply for. And the way it works is every period is 6 months after you can't apply, they shut it right down. So if there's anybody who's tardy out there with applying for Qs, now's the time to get on as many of them as you can. And you'll be surprised, a lot of clients of mine qualified when they didn't think they would, because you're able to either compare your current month to the previous year's month, or if it's this year, then 2020. So pre-19 pre-COVID. And then if the other thing you can do is you compare it to the average of January and February of 2020. So if you had a good January, February of 2020 right before Qs, you may find that, or before COVID, excuse me, you may find that you qualify for it, or you may get some of it. So, and I understand some people have a moral point of view, an ethical point of view, if you will, that, I don't take money from the government, and, I'll go it alone. I respect that as well, but it's not a bad idea to know if you do qualify for it, you can make that decision. And like I said, a lot of you would be surprised that you probably do get some of it because it was an extremely generous program. The CEBA, I bet a lot of you got this. It's gone. So that's the Canadian Emergency Bank account. If I remember, that was the 40,000, and then the 20,000. You could do 60 total. So a lot of you probably have that. So you have $60,000 that you may have taken or may not have taken. My advice is, if you have it in a line of credit or a credit card, banks sort of all did it differently, is to take it out of your bank of that account and use it. We're concerned that, when you pay back the 40, because you get to keep 20, if you never used any of it, you don't have a good argument with the government that you needed that money in the first place. So I have a few clients that were sitting on it, and I said, just take it out and use it for business operations. That way we can show that you did use it for the business, and you should get 20,000 forgiven. But again, that's the concern we have, that, when this is all due, and it's due December 31st, 2022, if you don't pay it, if you don't pay it back, the 40,000, it becomes a term loan, and there's going to be interest charged against it. And I can't remember how many years it is. It might be 5 or 10 years. I'd have to check it, but it becomes a term loan that you'll have to pay back over time, and you don't get that 20,000 forgiven. So it makes sense to pay that loan back, that 40,000, to get it from a line of credit or wherever else, and just pay it back. But again, if you have it available, it's important that you take it out and you actually use it in the business. Otherwise, you may have some problems in the future.
Hey, John, and again, I don't know if this is, I know a lot of these programs, when they came out, it was like, here's what it is. We'll figure out what it all means later. But in the scope of the 20 plus the 40, the 60, the CEBA, so next December, you pay back your 40,000. They waive the 20,000.
Yep.
Is there a position on the 20,000? Like, are small business people going to have to pay tax on that waived money, or is that up in the air? Any idea? Or?
Yeah, great question. Yes. So the short is, if you anytime government gives you money, you got to give some of it back. so yes, you'll have to put it in as taxable income. There's it's beyond the scope of this course, but there's a good argument that CRA could make that when you actually got the loan, the year you got the loan. So if you have a fiscal year of January to December, and you got the loan in 2020, you actually were supposed to take that 20,000, put it in income that year. So they actually, we haven't seen any reassessments on that yet. But reading, the Income Tax Act, the 20,000 technically should go into income in 2020. A lot of people are probably going to take it into income the year that it's forgiven, but it's technically taxable in the year that you took it. So that's a bit long-winded answer, Mark. But yes, you do absolutely have to pay tax on that 20,000.
Sorry to hear that.
Yeah, I'll try to give more good news. Not all doom and gloom. The SECRA, this was for tenants and landlords. This is done. This is no longer available. But it was basically we were splitting it. So 25% hit for the landlord. So he only got, or she only got, 75% of the rent. and then the tenant had to pay a quarter, and then the government picked up the rest. So the paperwork for this was not fun. I did it for a few clients. Not a lot of people took advantage of it, actually. It was only a couple. That's why I'm a little hazy on all the details, because, like I said, it was only once or twice I actually did apply for it, but that's no longer available. The tourism, I think that should be tourism and hospitality recovery program. Not going to go into too much detail on that one. There's some details on the link on the bottom, or just Google it, and you'll be able to see it. The HASCAP, which is the Highly Affected Sectors of Credit Availability Program. The government loves these long terms, long acronyms. So it's something you're able to get up to $1 million in loans. So it's $25,000 to $1 million in loans that you're able to get if you're able to show that you've been highly affected. There's a whole bunch of conditions there. Again, if you want to take a look at it, if you're in the tourist business, cruises, and I can't remember if hotels are not in that or not, but if you can potentially get that, go take a look at the website, and talk to your accountant about it and see if you can apply for it.
I think I had a client who was in the food services space, more in the catering side, that I think they got some access in that space there. And one thing I'll just mention too, John, we got about maybe, I know everyone's usually back to back in these COVID times and meetings.
Right.
I'd love to finish up at maybe 10 to 2, so we got about 10 more minutes.
Okay, appreciate that. Yeah, here I was thinking, did I have enough content? But I guess I'm a good just rambling on here.
You're doing well.
Okay, appreciate that. Okay, I covered this stuff, so let's move on. How to avoid an audit? I get this question a lot. These I sort of listed the top. Again, I don't have a crystal ball to see exactly how audits are done, but late filed returns are a big one that trigger audits. CRA has projects. They did a project. They've done so many projects, but one a couple years ago comes off the top of my head is. Servers in restaurants and bars not putting their tips in. They had a huge project on that. We know that they do look at expenses as a percentage of revenue, so it has to be reasonable for the industry. Like, I don't know if many of you know this, but you have to report what industry you are on your corporate return. So it's good to look at your percentages of expenses, because if they get silly relative to your revenue, good chance you're going to get audited on that. History of poor audit outcomes. If it didn't go so well in the past, you bet your bottom dollar they're going to be back auditing you again. So it's important, not only to save money when you're fighting with them in an audit, but if you don't do well, they're going to be back. And then people not using an accountant. Not that it's mandatory, but on the corporate tax return again. If you're using a CPA, such as myself, we say it, so they're aware of it. So it's easy for them to have Pile A and Pile B. Pile A done by accountants, Pile B not done by accountants, and I'm sure you all can guess which ones they look at more. Recent tax updates. Bill C-208, I could talk about this for an hour, but I'm going to keep it really quick. Bill C-208 is actually good. It was a private member bill, and it got fast-tracked back in July. And what it does is it allows more efficient tax planning within families. It allows children to set up holding companies to buy out their parents, and their parents to have capital gains exemptions, at a very general level. Before, we couldn't do that. So it's worth looking at, if any of you are going into succession plans, to consider C-208, especially if you want your children to inherit the shares. So it's a good section. Talk to your accountant about that.
John, just on that real quickly, and I know that we prepared a lot of info. We're probably not going to get through all of it today, but maybe that would welcome a second discussion at some point in the future.
Sure.
In any event, on the C-208, is there some kind of a deadline attached to that, or a deadline before they may change it, or what's happening?
Yeah, it was effective as soon as it came out in July. So I was actually doing an advanced tax course this morning. It's a timely question you have, Mark. I'm not going to talk too much about it, but there's actually a way to take your $900,000 capital gains exemption out tax-free right now out of a company, which was an unintended thing that happened as a result of Bill C-208. It's aggressive tax planning. but it was unforeseen, and I do know a couple clients, not mine, because I think it's a little risky, but they're doing it. So they're each pulling out about $900,000 out of their business and paying no tax whatsoever. So there is going to be a deadline for that. They're going to change it because they know they messed up on the when they drafted the legislation. So there is going to be a timeline on that. But Bill C-208, which is allowing the purchase of your company by your children using a company, that's probably going to be here for good. Capital gains are, I'm going to say at this point, likely going up next year. I'm not going to say 100%, but if I was a betting man, I would bet on it. Everything I hear is pointing towards 75%. It may be effective as soon as January the 1st. And if any of you are thinking of selling anything that'll generate a capital gain, think about selling it before December 31st. I'm not, again, don't take this as biblical. Like, I don't know this with certainty, but there's a reasonable chance, I would say at this point, that cap gains is going up because Mr. Singh holds the balance of power in Parliament. So for Mr. Trudeau to get through the next budget, Jagmeet's going to have to get some of what he wants, and us in the tax community are pretty certain that that's going to happen.
John, on that note there, if you had a I'll just give an example. Let's just suggest that you had a rental property that you owned personally. Could you potentially, prior to a capital gains inclusion rate change, sell that to a company that you own? Would that be like a legitimate transaction, or would that be kind of, if you're selling it to yourself in a sense, that would negate the ability to use this opportunity?
Yeah, that's a great question. So you can do something called a Section 85, which it lets you roll in a property into a company and not pay any tax, with the exception of land transfer tax. Everybody else forgets about LTT. That creeps in very often, but it's sometimes it's a smaller consideration depending on the price. But yes, and you can actually choose to trigger a capital gain mark and bump up the ACB. Of course, clients are saying, should I just do this for sure right now? And I'm saying, well, maybe, because if I make them pay tax and then the inclusion rate does not go up, then I have egg on my face. So that's why I'm saying likely, but not for sure. And if they do it, I think for sure they'll do it for January the 1st. And a lot of clients are saying, why won't they do it for March or April or whenever the hell the budget is? And I say, because the tax returns are going to be too screwy. You're going to have one period of the year where you get 50% inclusion, then another period of the year where it's 75. This happened for anybody who's been around a little bit longer than me back in 2000, where they changed the rate twice during the year and it was a mess. So chances are they'll do it for January the 1st if they're going to do it. So talk to your investment advisor, talk to your accountant, and something to think about for sure, because it's going to definitely affect your tax liability, especially if you're thinking of selling something in January or February next year, or anytime next year. I would think about selling it now. And I don't like the tax tail to wag the dog, but it's an important consideration. Okay, capital gains stripping, that's, again, something I could talk about a lot, maybe another course, because the capital gains inclusion rate may go up, or they may just legislate it and get rid of that. Don't have enough time to talk about that right now, but it's something to talk to you can talk to me about it, or your accountant. They're doing a crackdown of habitual house flippers right now. I'm seeing a lot of that in audit, where people are living in a house for a year or less sometimes, getting their principal residence exemption, because we're in a highly inflationary time, especially when it comes to homes, and they're making a lot of money. They're now charging tax as if those people are builders. Luxury tax, if you are planning on getting, yourself a new Mercedes or something nice, starting in January, there's going to be tax, and I put the calculation there below. So run out and get yourself a luxury car now if you were going to do it later. If it's under 100,000, you're fine. But if over 100, you got to worry about that. Any of you have trusts, there's mandatory filing. So, if your accountant doesn't know that you have the trust, tell them, because they have to file it, and remind them that they have to file it if you've just been sending a letter in every year because you don't have any income. So that's a new change as well.
Good. You know what, John? Maybe I'll give you a minute to talk about corporate structure. I know this is your sweet spot, so you probably want to give it an hour, but maybe touch on it. Maybe we could pick it up in a feature session.
Yeah. This was the last section, so I'll keep it as quick as I can. A lot of you probably don't have the best corporate structure. Some of you may, but a lot of clients that come through my door don't necessarily have the best structure. There's a lot of people who have set up holdcos that own opcos, and then they think they're done, and they're actually shocked to find out they don't get capital gains exemption when they sell their business or other problems. So it's really important, to a tax lawyer or a tax accountant to take a look at your structure. My little plug here is I'm happy to take a look at it for an hour and give you some general advice. Feel free to contact me, and hopefully we can come up with a better plan. But there's so many advantages to having the right structure and so many disadvantages to not having the right structure. The other thing I'll say is family trusts are big right now. Almost, I'd say, a better part of my corporate clients, we've at least considered it, and a lot of them we've implemented it. Excuse me. Another thing to think about too is secondary wills for your business. This gets missed all the time as well. It'll be probate at death. And I just said not all lawyers and accountants are experts in restructuring. So don't necessarily assume your accountant or your lawyer is happy to give you advice on restructuring your business. So, you may need to bring in a third party, or maybe they are, and you need to get the conversation going. But, it's kind of like when you go for a health checkup with your doctor. You should do this every few years and make sure you have the right structure. And with that, I'll turn it over to you, Mark, and see if there's any questions. And I think we're right on time so far.
Yeah, well, I'll tell you this, John, for sure. My experience of working with growing business owners is oftentimes they grow out of their advisors. Oftentimes they, started with someone and their business has got to a space that maybe is beyond their level of knowledge. And one of the great reasons we had you on today is because I know you're the sort of accounting professional that can obviously help people take things to the next level. So great points there for sure. I don't see any questions per se. I know we have up on the screen here just how to get a hold of us, how to get a hold of John. John, just out of curiosity, I mean, as we're kind of moving into tax season, I sort of feel like at some point you guys kind of close the doors and say, don't talk to me until after tax season if you want to change your accountant. So yeah. If somebody did want to get a hold of you for maybe a structure conversation or maybe just a second set of eyes on what they're already doing, when would you prefer to have that conversation by before you get really busy?
Yeah, that's a great question. Anytime around now is great. I would say up to Christmas is really good. December is actually a quiet month. You'll probably get some more free advice from me if you call me in December, to be honest with you. January starts to heat up and we have to start tax planning for the next year. February, I don't want to say I'm unreachable, but if you're not a client, I'll have limited time to discuss matters with you. We have so much work starting in February, and then we go pretty hard to June. So those restructuring type questions, or capital gain stripping, or is a trust a good idea, all that sort of stuff. I'm thinking about selling my business. I want capital gains exemptions. All those sort of questions are great to approach me, I would say, from now until Christmas.
Great. Well, that's great. John, really appreciate it. Thank you so much for taking the time. I invite anyone on here that if you have any further questions or some follow-up, please feel free to reach out to John or myself. Happy to get you in touch. Again, we're based in Mississauga, kind of near Streetsville. John's in sort of east end of Oakville near the south, and so we're kind of local if you're in that neck of the woods. Quick thing I'll give you is we're going to do our next webinar session on February the 9th. That will be our next session where we'll be continuing what we've dubbed now as the foundation series for emerging entrepreneurs, people that are kind of building up their business to make sure you're on the right track. Topic to be announced, and we will send an email out afterwards in the next few days with the slide deck and recording of our session. So thanks everyone, wishing you a great finish to 2021, just a few weeks to go, and wishing a wonderful 2022 as well. And thanks again, John. Appreciate all your context and support.
My pleasure. Take care, guys.